It's time for Wise Money with Korhorn Financial Group with certified financial planners Kevin Korhorn, Mike Bernard, and Josh Gregory.
Welcome to another episode of the Wise Money Show with Korhorn Financial Group, where every week we're helping you take your next wise step in your financial life. Thanks for being here, friends. My name is Mike Bernard. I'm your host. I'm also one of the certified financial planners on the program. And with me in the KFG studios, my business partners and fellow CFPs, Kevin Korhorn and Josh Gregory.
As 2025 comes to a close, so does your window for making some wise tax moves that can save you thousands. On this week's episode of the Wise Money Show, we're going to be walking through the Fall Tax Planning Playbook. We'll be discussing Roth conversions, capital gains harvesting, and wise charitable giving. Everything you can still do before December 31st to lower your tax bill and improve your plan.
That's right. Sharing different strategies, different ideas applying to whether it's you individually or if you influence or own a business, incorporating the new tax laws. All of that is working towards a checklist that we'll share with you here at the end of the program. If you have a question for the show or have any needs, we are here for you. You can call or text us 574-222-2000. That's 574-222-2000, online wisemoneyshow.com. You can engage with us that way or on social media. Wherever you're at, we are there as well. Search The Wise Money Show. All right, one of our favorite tax planning strategies, you've got to rule it in or out every single year. You have to answer the question, should I do a Roth conversion? Just a few weeks ago, we did an entire show devoted to times when you should consider a Roth conversion. So if you haven't checked out that show, I'd encourage you to do so. Go check that out. Listen to it. We're sharing a few times when you've got to at least consider it, okay? But today, it's sharing the spotlight. Certainly, the Roth conversion is one of your year-end tax planning strategies you got to consider, but it's just one of several that we're going to get into today on today's show. But all of that is part of this season, which is ripe for tax planning. Guys, tax planning is one of the 6 areas of your financial life. Let's dive into what is tax planning all about and how does it fit with the rest of your financial life?
When I think of tax planning, I think of optimizing my tax situation, because Joshua, in the hook or the description of what today's show was, talked about, let's do everything we can to reduce your tax bill. And I don't know that that's always the right answer. Is as horrible as it sounds, especially if you believe that taxation is theft. You think, well, wait a minute, so more theft is better? No. It's looking at the long term and saying, okay, I have income. What year should the income enter into my financial life, and what taxes should I pay on that income as I go? And am I the best person? Are my wife and I the best people? Are my children better off paying it? Is someone else related to me better off paying taxes on that?
Yeah, that's exactly right. Taking the long-term approach to reviewing the overall tax bill that you're going to pay throughout your lifetime, or that is attached to these dollars that might extend beyond your lifetime to your kids or grandkids even. But, I think of tax planning. I'm glad that you framed this, again, as a financial planning issue, because so many of the tax planning ideas that exist for you, the strategies and the potential tax efficiencies that you can gain, they are found by analyzing all the areas of your financial life, right? Sometimes it's in reviewing your investment portfolio that you realize, hey, there's some tax savings I can take advantage of here. Sometimes it is thinking about your long-term goals like retirement or funding your kids' education, and you realize, hey, if I do this right, there's some great tax savings here as well. And so by looking at the big picture and recognizing that often taxes they're going to have an impact on all areas of your financial life or be influenced by all areas of your financial life, you recognize just how integrated your entire financial picture really is.
Yep, that's exactly right. There's 6 areas to your financial life and my financial life, everyone's financial life. Tax planning is one of them. That's not tax preparation. Tax preparation is reactive. Tax planning is proactive. It's optimizing how to pay the least amount of tax over your lifetime, if not multiple lifetimes. But absolutely, that is connected to your cash flow, your present financial position. It's connected to your protection planning very directly to what you pay for your health insurance or and other areas as well. Your investment strategies have tax considerations and tax component. how much taxes you're going to pay in retirement and whether you should structure certain tax shelters or funding certain tax shelters. Is that better for you in retirement, or, to do Roth or pre-tax? And then all of that has to do with your estate plan as well. Which dollars do you want left over? What's the tax treatment of that? And so it's integrated, like you guys said. So we're going to go in clusters today, and we're going to first just open it up and say, what are the tax planning strategies you've got to consider between now and the end of the year for your individual and personal situation, and then for businesses. And then I'm assuming there will be some overlap here, but specifically shining a spotlight on the new tax laws. What are some things you need to consider? So we'll start with individual, your personal situation. What are some tax planning strategies you've got to consider before year end?
Well, one of the tax planning strategies is making sure your tax favored investment accounts are funded appropriately. So there are different limits, and we've talked at length in different shows about the different ages that these limits change. And some, they go up for 4 years and go back down and do all kinds of crazy things. So I'd want to be totally in tune, especially now. It might be a little late in the game if your contributions have to get in via payroll deduction.
Yep.
Some of your retirement plan at work can only get in. You can't write a check to your 401k. It has to come out of your paycheck. So I would make sure that I'm getting the right amounts in. But the tax, so that does help with tax planning. But the tax planning piece of that is that before tax or Roth, as I'm funding these accounts.
Yeah.
Yeah, and the decision on whether or not to use a traditional retirement account or a Roth account fundamentally is a tax question, right? Like, am I better off paying the tax and then allowing those after-tax dollars to go into the account, or do I want it to go before taxes and actually reduce my tax bill this year? Well, it all depends on what is your tax bill going to look like, right?
Yep.
Both now and out there in the future. And so to me, no matter what, as we get into all these different strategies, the foundation that you want to operate from is a forecast of what you think your baseline tax picture will look like if you do nothing. And then you're working with your certified financial planner to analyze, essentially, or as Kevin said, optimize which scenario do I want to have play out in this calendar year. Are there still things I could be doing to take advantage of the window of time that still exists? One of those that we talk about every year, this time of year, is should we consider a Roth conversion?
Mm-hmm.
And again, we've devoted entire shows to this. It's one of the most common questions that we get on this show. Does it make sense? Well, fundamentally, you've got to ask yourself, all right, if I do the Roth conversion, I'm going to be taking money from a traditional IRA and moving it over to a Roth IRA, and I'm creating extra income on my tax return. How much extra income do I want to show? How much do I want falling in my current tax bracket, and how high am I willing to go on my tax brackets? What makes sense? You can't just guess on this stuff. Like you want to be, again, optimizing and analyzing this within the context of a tax projection.
All right. So 2 plus the foundation, just to repeat what's been said. 1 is look at your payroll contributions to your retirement accounts and see where you could potentially increase those contributions, because those have to come out of payroll. You can't get all the way up till the last paycheck in December and say, oh, shoot, I wanted to contribute more. How can I get more in? Well, it's based on pay stubs. You've probably got 4 of them left. If you're going to increase what you're doing right now to hit that maximum, go do that. You only have until the end of the year to do that. That's 1. 2, consider the Roth conversion, absolutely. But all of those decisions need to be based on a foundation of a tax projection, is what we call it. What about just taking your required minimum distribution and knowing what to do with that? You've got, whether that's you're over age 73 or past your required beginning date, or you've inherited an IRA from someone that was past their required beginning date, or maybe under the old rules, the stretch IRA, you are forced to take a required minimum distribution out of that account. And that's got to be done in the calendar year. You don't have until April 15 to do that. You do have that in the first year. Most people don't exercise that because then you got to double it up. But right now is the time where you likely have the most clarity on what your tax picture is going to look like. and knowing that required amount, I'm seeing a lot of people where we're taking that required amount and we're withholding all of it for taxes, just about all of it, and then doing a Roth conversion above and beyond that.
Yeah, but you can't convert
right
the required
minimum distribution. So pretend your required minimum distribution was $30,000. Mike's saying, hey, look, we're withholding $20,000 for Fed and $10,000 for state. We're withholding 100% of that for taxes. I like that.
Yeah, and then if you do a Roth conversion above and beyond, then you've covered the taxes. So, all right, we've got more coming up here on the Wise Money Show with Korhorn Financial Group. Hello, YouTube. Thanks for being here. This is the Wise Money Show. What you're watching right now is our weekly 1-hour talk show that airs right here on this channel, 10 a.m. Eastern Time, every Saturday morning, and also on podcast at the same time as well, but also on a couple local radio stations here in our neck of the woods, which is northern Indiana, southern Michigan, and that's why we've got breaks and segments and all that for the radio. So we've got special bonus content that we're going to hit and the next 2 breaks as well, so make sure you stay tuned for that. But if you're also looking for other content that's not long form, it's shorter, even reels or shorts, we've got all of that right here on this channel. So make sure you hit that subscribe button, turn on notifications so you're made aware every time we drop new content. If you like the content, leave questions as well. We appreciate it. All righty. I had to cut you off there.
I was ready to go. I was loaded.
Yeah. All right. We'll pick it back up. All right. Short break. Here we go.
So do I finish my other idea?
Sure, you can.
Okay.
Yep. All right. If you are required to take a minimum amount out of a pre-tax retirement account, maybe one that you inherited from someone else, make sure you do that. You've got until 12/31, but what do you do with it? We're helping with that right now. This is the Wise Money Show with Korhorn Financial Group. My name is Mike Bernard. With me in the KFG studios, Kevin Korhorn and Josh Gregory. Stay up to date on all Wise Money content. Find us online, wisemoneyshow.com. You can leave questions there as well. And then all over social media, wherever you're at, we are there as well. Search the Wise Money Show. All right, we are building your fall 2025 tax planning playbook. We've got that checklist we're going to share with you at the end of the program, but we're talking about different tax planning strategies you've got to consider implementing right now while there's still time before the end of the year. You've got to take your required minimum distribution. If you are age 73 or older, then you've got to take a required minimum distribution from your pre-tax retirement accounts. If you've inherited an IRA from someone, whether they passed away before 2020, and you can stretch that those withdrawals, or they, and this is new for this year, or you inherited that account from someone that passed away after 1/1 of 2020, if they have already started their required minimum distributions before they passed away, you've got to carry on those required minimum distributions and still empty the account within 10 years. So that's a new rule this year, and that's part of your tax planning. Kevin, I cut you off. You were just sharing a scenario where people are withholding 100% of their RMD.
Well, with the required minimum distribution, some people are already taking distributions, and those will likely cover your required minimum distributions if you say, hey, I'm living on my retirement plans. Some people haven't touched their retirement plans. So when you get to 73 and you say, hey, I've got to start taking money out, and you say, what do I do? Mike gave the idea, which I like, of saying, all right, withhold 100% of this for taxes. So I'm taking out $30,000. I withhold 20. It goes straight to the Fed and 10 to the state. And there we go. My tax bill is satisfied. There's another thing that I could do if I'm looking for some sort of tax favor is instead of giving through my checkbook to the church or other charities, I could do a qualified charitable distribution if I've never done that. And I could send that, it's that same number, I have $30,000, I could send that straight to my church. And if it goes straight to my church, it never ends up on my tax line. Mm-hmm. And so I'm not having to pay taxes and then get the money back, but not get the state money back and blah, blah, blah.
And what that does for a lot of people is by not having your required minimum distribution add $1 worth of income to your tax return, it leaves some room potentially for you to do the Roth conversion. And so you were kind of referencing that as well, Mike, that sometimes stacking these strategies on top of each other and coordinating them, get your qualified charitable distribution handled. Now your required minimum distribution, you can check that box and satisfy the government for another year. And now, because your required minimum distribution is handled, now additional distributions could be eligible for the Roth conversion.
Yep. giving, this is a lesser known nuance within the new tax laws, which we're going to hit in more detail here soon. The giving rules for deduction are changing. A lot of the new tax law changes take place in 2025, but there's a few that start in 2026, and that's one of them. They're bringing back this, well, you don't need to itemize your taxes in order to get some charitable deductions. You're going to be allowed to get some charitable deductions if you're charitable, even if you don't itemize. But that starts in 2026. And the offset to that is, well, starting in 2026, if you do itemize, some of your charitable deduction won't be allowed. It's going to be, it's subject to a floor. And not a cap, but a floor. Well, there is a cap as well, by the way. No one talks about that either. But so all that to say, it's subtle changes, but it's changing 2026. So consider bunching your contributions right now in 2025. And we know the rules. Like some of these nuances, if you think, yeah, I'm going to itemize, then go for it. And you've got the resources, go for it and make 2, 3, 4 years of contributions, of donations to what's called a donor advised fund so that you can stack those benefits all in this year when there is no floor subject to your charitable contributions for your itemized deductions. Go for it. And how do you do that? Donor advised fund allows you to get the benefit of that completed gift while still having some control and influence over when you release those dollars to the end charity. Mm-hmm. And so it's sort of like the best of both worlds. And you've got to make that donation. You've got to make that contribution by the end of the year in order for it to count for this tax year.
Yeah, if you're listening and just barely holding on, I'm telling you, these strategies work. I was just working with one of our rock star CFPs, Ben Chambers, and we had worked on a case together with a client, and they are very charitable. And so we did this, and we in a particular year, we bunched these contributions up, and that allowed us to do some planning with IRA to Roth IRA and some really awesome stuff. Well, that was 3 years ago. Well, 3 years has come and gone, and now it's time to do it again. Mm-hmm. And the client is excited about it. And because you think, wait a minute, would I really ever get excited about a tax plan? Yeah, it is cool. If you've never done tax planning, make this the last year you don't do tax planning.
Yeah. Okay, so in that scenario, 3 years ago, you did some charitable gift bunching, and so they were itemizing their deductions that year. In the next 2 years, were they taking standard deduction?
Yes.
Okay. So this is a way for you to kind of bounce back and forth between itemizing your deductions or taking the standard deduction. For some people, it's the only way they ever will be able to itemize is by doing this type of bunching. If you're going to do that, though, like if you're going to have a year where you are itemizing because of some creative planning that you're doing, keep going with it. Look even closer, because now that the tax law has changed with state and local tax deductions, it used to be that you could only write off $10,000 per year of taxes that you paid, state income taxes, your real estate taxes on your home, that sort of thing, local county taxes if your county has that. That number sometimes could get well above $10,000, but you used to be capped. Now the cap has increased to $40,000. And so what if, just like bunching your charitable contributions in this year, you may, if you're doing quarterly estimates or something to your state, maybe you get that paid before the end of the calendar year instead of waiting until it's due on January 15th. Get it done in December, and now you're counting it on the same tax return along with those bunched up charitable giving. So again, keep stacking the strategies is the idea here.
I'm going to throw one more in here that would apply to you individually, and then we'll transition to business. And that is, just like we said, the first one, tune into how much you're contributing to your 401k and Roth or pre-tax, because those contributions need to go out of from your paycheck. You've got a few paychecks left, so maybe tune into those and make some adjustments. Health savings accounts. If you have an HSA eligible high deductible health plan, you can contribute to your HSA. You're not forced to, but you can. And you actually have two ways to contribute to that. Out of your paycheck, where it's a deduction, Fed, state, and FICA, or out of your pocket where it's a deduction fed and state? Well, you've got a couple paychecks left this year. And so if you want to top off your HSA, it may make sense to do that out of your pocket. Meeting with a friend recently, she's got a surgery coming up. And on top of that, husband's going through physical therapy on his shoulder. And so like they're getting banged up here. I don't know what they're doing, but they've got some medical expenses. Let's just say that. And the original plan was not to max out their HSA this year. They had some other financial priorities. So even though that's a tremendous idea, we love it, I encourage it. From a prioritization standpoint, you can't put the same dollar in two different places. So we said, just fund what you're doing to the HSA, but we're not going to be able to max it out this year. Now they've got this surgery. They've had these out of pockets for physical therapy. And it's, oh no, we need to make that a priority because these expenses are coming, whether we like it or not. And there's still time to sneak those contributions in via payroll. So it's going to save not only Fed and state, but they're going to get the kicker of an extra 7.65% benefit because they're saving on FICA as well. Versus if we just said, okay, well, let's wait for these bills to come in and then make a big contribution into your HSA and then use your HSA to pay the bill. No, we're going to get ahead of it and be able to save not just Fed and state, but also FICA as well. The topping off of the HSA, that's one of our favorite after the fact tax planning strategies that you can do up until April 15, but you won't be able to contribute out of your paycheck at that time. You'd have to only write a check. So those are a handful of tax planning considerations for individuals. What about if you influence or own a business? We've got that and more coming up on the Wise Money Show with Korhorn Financial Group. Alrighty. Bonus question. Hang on.
So how do we know if we're an influencer?
We're not.
You have followers?
I follow myself around all day.
Just did a Wise Money Next Wise Step video. If you haven't seen it, go check it out. That was, well, if I was starting my career at Korhorn Financial Group today, what would I do differently about my savings than how I actually did it? So I'll turn the question to you guys, and we don't have a ton of time for it. So just if you were starting your career today, how would you fund your retirement? What would you save into?
The Roth side.
The Roth IRA or Roth
401k.
Roth 401k.
Yeah, and Roth IRA. We've got HSA. It all depends on what you're earning, but I don't know. It's easy to be tempted early on in your career to say, but I can get some tax savings. Like I can get a bigger refund, and that just feels so valuable to me right now.
Because you have no money.
Exactly.
You're scraping it together.
Right.
Exactly.
And you say, okay, because I remember toggling back and forth using TurboTax when I didn't have any money and I didn't make any money, so it was pretty simple. And I'm like, well, if I put this $2,000 in the Roth versus I put the $2,000 in the traditional, what does it look like? And I'm like, okay, if I had an extra $600, what would I do with it? But this is, this is the short-sightedness.
But back then, that extra $600 was part of what you were using maybe to fund the IRA or the Roth, right? So
right.
I don't know.
So it is hard. The only thing I would tell someone, if I wouldn't think as much about which vehicle, I would just think my philosophy has always been the where do my first dollars go? They go to filling up the tax favored buckets that are available to me, and then I get to live on, and I got to pay taxes, and then I get to live on, and I got to give to God what He asks, and then I get to live on the rest.
Yeah.
And so that's what I get to live on, instead of saying I'm going to put my living expenses in first and try and squeeze some stuff out at the bottom.
And you're exactly right. That is the more important question of what is the right amount to save? How am I going to put a governor on my own spending and lifestyle? And then where it lands is like fine-tuning optimization, in my opinion. But you got to have the resources in order to grow anything, right? Whether it's an IRA or Roth, at least we're talking about resources that are piling up for the future.
Yep.
So
Good.
it's good.
All right, third segment, we're going to get into hit a couple quickly business deductions and then get into ones that we haven't touched on with the new tax law. So third segment, here we go. What parts of the new tax law that was passed in the summer of this year are influencing your tax planning? Because if they're not, I would tell you to run, don't walk, to your certified financial planner's office and make sure that you build out that proactive tax planning before the end of the year. We're sharing ideas for that right now. This is Wise Money Show with Korhorn Financial Group. Thanks for being here. My name's Mike Bernard. With me in the KFG studios, Kevin Korhorn and Josh Gregory. Every episode of the Wise Money Show is on podcast wherever you listen. Just search the Wise Money Show. Subscribe to it there. Rate the program there as well. We appreciate it. Helpful feedback for us. We're building right now your year-end or fall 2025 tax planning playbook. We've got the checklist coming up in the very next segment. Just popcorning, sharing ideas right now. We've shared several that relate to just all of us as individuals, what you should consider. A couple for businesses. And, we were talking about whether you bunch your charitable contributions. Businesses sort of have that same choice as well. And this choice changes with the wind, it seems
it
like.
does.
But you've got a choice. When you are making I'll just say a capital purchase, if you are making a purchase for your business, there are rules that say, well, when do you get to deduct that purchase, that expense?
And can we clarify what we're talking about here?
Yes,
because as a business owner, you might be putting a new vehicle into the fleet. Maybe you're buying a new machine or some sort of equipment. Could be you're adding on to your warehouse because you need more space. Whatever it is, it's often a major expenditure. Huge cash. Maybe you've borrowed money to do this, or maybe you saved up the cash. But the point is, it's some sort of business improvement that you're doing. This is not, just buying a new coffee maker for the break room,
paper or
right?
whatever. Those are expensed, immediately. But those other items that Josh mentioned, you have a choice. Typically, you have a choice. The rules are you get to deduct a little bit of it over time. 5 years, 7 years, some really big items are 15 years or 30, 28 years. Long time. Even though the cash is outlaid immediately, you don't get a write-off or deduction immediately unless it qualifies for something called a Section 179. And if you own a business, you've got that T-shirt. It's your favorite shirt because that's where it's like, oh, yeah, actually, I can choose to just write this all off in 1 year. And at different times, there have been really loosey-goosey rules on what can qualify as Section 179. Other seasons, it's very, very strict. And we're back to I don't want to say loosey-goosey, but that's the term that came out of my mouth. It's very open and very flexible. There's a lot more things that you can choose to deduct all at once versus be required to deduct just a little bit over time. But you have that choice. Exercise that choice. Not just the choice of, well, should I go out and buy a big vehicle? No, but work with your CFP doing proactive tax planning to see, well, what expenditures are necessary for the business, and then how should we depreciate those?
Right. And I was just working with a business owner right before the October 15th tax filing deadline. And it was kind of funny because as I was talking with my son Caleb and I was telling him, hey, we're getting the last minute tax returns filed. He said, what do you mean? I'm like, well, we got to get the tax returns filed before October 15th. And he said, what are you talking about? And he didn't understand that there's an automatic extension to October 15th. And in his very responsible brain, it didn't make sense that anyone would drag out the misery of filing your taxes. But some people just have very complicated financial lives, and it takes a while to get the year-end stuff done, and then that has to go to the right people and get fixed and other things. But if you look and you say, hey, I could take a 179 deduction of $100,000 this year, what is my income this year and what do I think it will be in subsequent years? Because if moving forward, I think my income's going to be higher, I probably want to take the least amount that I can take this year and push as much of it into future years.
That's right. I mean, whatever that piece of machinery was that you purchased and you're putting into production and everything, part of the reason you're doing it is because you're believing that it's going to help you be more profitable, right? It's going to help you generate great business results, which means that there might be bright days ahead, which could translate into higher income or higher profit, which means higher tax out there in the future. Yeah. And so one of the decisions that you as a business owner are always going to be wrestling with is, if I have big profits out in the future, do I want bigger deductions out there to match up with it as well, so that I can kind of levelize or plan out where ultimately am I going to be paying the taxes? What tax year will this fall into?
Yep. A couple others really quickly for businesses. If you're an S corp, you have influence over your salary. What you set as your salary it needs to be fair and reasonable for the work that you do. But then there's a choice. Well, the rest of your income, is it considered a distribution of profits or dividends to you, or should it be salary? You've got to make that decision, and that can often be influenced by the qualified business income deduction and that planning. So you'll want to review that. Of course, figuring out your own retirement plan contributions. If you're self-employed and you're the only employee, or maybe it's just you and your spouse that work there, maybe setting up and funding a single K or solo 401k, that can make a lot of sense. Maybe a SEP IRA would make sense. Maybe starting a retirement plan would make sense for your business. And then lastly, health insurance decisions and choices. As a business owner, you get to make those choices. And so, yeah.
Those are huge decisions, because you kind of flew right past if it's just you and your spouse. But if it is just you and your spouse, or if it's just you, the 415 limits on a 401k, you're talking you can get $70,000 into a retirement plan.
Yeah.
So I would dig deeper if that applied to me.
Yeah, I did gloss over that. Anytime you're working with a new financial planning client, they come in and say, "Oh no, yeah, it's just me." It's like, "Oh, it's just you. Anyone else helping?" Well, yeah, I've got one person part time. Are you married to them? No, I'm not. Oh, shoot.
Is it your child?
Yeah, right. Because if it's just you, then there's the single K, this solo 401k has a lot of flexibility, but
it's very sweet.
It's just you. All right. We've touched on some of the tax planning strategies within the new tax law, but what are some of those that you would just draw out? We've done full shows about the new senior deduction. I would make sure that you're optimizing for that. We just did a show recently where I boldly said, if you're eligible for the new senior deduction, that is your age 65 or older, and your modified adjusted gross income is below the thresholds, the phase-out threshold, so $150,000 married, filing jointly, $75,000 everyone else, you have to do a Roth conversion. I didn't even give you the choice. You have to do it. Well, there is a choice. If you're not paying tax on the full amount of your Social Security, you want to be careful with this and run the numbers. But let's just say if you're qualifying for this new senior deduction, you have to do tax planning. Like it's not optional.
Yeah. Because your tax picture just swung dramatically.
Yeah.
You didn't have to do any work for it. Congress made it happen. And it has created an opportunity for you. If you do nothing, then it's possible that you end up just paying very little or maybe even no taxes. But as good as that sounds, boy, whenever we hear someone's in a 0% tax bracket, if we find that out after the fact, then we're kind of disappointed because maybe we missed an opportunity, right? An opportunity to proactively pay some taxes above the zero that you could have paid. And maybe get yourself back into paying 10% or 12% or something more historically reasonable. Still a great deal by historical standards, and maybe even a great deal compared to where you might land out there in the future as well. Because what we know is a lot of these tax laws, they didn't exist 6 months ago. Are they going to exist 6 years from now or 10 years from now? I don't know. I just know, man, in my career, the number of tax law changes that we have experienced is breathtaking. Mm-hmm. And it's going to continue. And that just means the planning that you do today is going to set you up, hopefully, for better and better options out there in the future if you play your cards right.
Josh, you said breathtaking. I'd say mind-numbing. Like you can't really follow it. It's really difficult. And yeah, like most of these have an expiration date of 4 years. They're gonna expire. So do you take advantage of it now, or do you say, oh, they'll probably keep it around forever? My base case is that they're not going to keep these around forever. So optimize it. What are some of the other things within the new tax law changes that need to influence your planning this year? And then all building towards what is your year-end tax planning checklist? We've got that more coming up on the Wise Money Show with Korhorn Financial Group. All right. Favorite tax credit or tax deduction? You can't have favorite children, but you are allowed to have favorite tax credits and tax deductions.
Well, I can tell you this. If you do have children, they will tell you that you do.
Yeah. That you have favorites?
Yes.
And it's always one of the other ones?
Oh, yes. Oh, yes.
Big grief.
Yeah. Not that's not true. Well, I'm not going to say anything. I think for me,
yeah.
The scholarship granting organization deduction. So if I live in Indiana, or if I live just over the border in Michigan, but I pay a lot of taxes to the state of Indiana, I can get a 50% tax credit if I make a contribution to an organization that has a scholarship granting organization, or an SGO. So if I give $10,000, I get a $5,000 credit. Now, we like credits better than deductions, but so now my $10,000 really only cost me $5,000 to give. I've often talked with friends about sacrificial giving, and do we ever get to sacrificial? That takes the sacrificial out of sacrificial giving right there. But wait, as Ron Popeil would say, there's more. Because that $10,000 is also a charitable deduction. So if I itemize, depending on my tax bracket, but if I say I was at $10,000 and I had 30 in the 37% tax bracket, now all of a sudden I get another $3,700 of benefit on the federal side. So now I'm at $8,700, and if I did it on my credit card and I had a 2% cash back, I'm at $8,900.
Wow, that's cheat code right there.
That's right.
I would say something similar, because Kevin, what you're saying is I was going to do this anyway, and there's all these unbelievable tax goodies. That's why I would throw the retirement savers credit in there before they mess it up, which they're going to do in 2027.
Wow.
But yeah, you should be saving for retirement anyway. And if you qualify for a credit, not just a deduction, like a tax credit that you don't need to repay for what you're going to do anyway, retirement savers tax credit. Oh, my favorite.
You know, over the years, one of the credits that we've helped a lot of clients to get themselves qualified for, and it can just have a major impact for them, are a lot of these college credits. You know, when you get to those expensive years, and maybe you're taking advantage, in Indiana, we've got the 529 plan that allows you to knock up to $1,500 off your state tax bill if you contribute $7,500 to our 529 plan. That's pretty fantastic. But then on top of that, if you get a credit on your tax return for the college expenses that you have, all of a sudden you start piecing together what feels like a form of financial aid. And sometimes that's for families that, just needed all the help they could in order to get that son or daughter through school without borrowing too much money and everything. So I don't know. Sometimes those just come at just the right time, and they provide enough of a lift, and it's an encouragement to a family that might feel strapped for cash during some expensive years.
Absolutely. All right, here we go. For a segment, Land on the Plane, we'll touch on a few more of the tax planning. We got to hit salt cap stuff, and then we'll get into the checklist. I have no idea how long the checklist will take. 8 minutes, probably 5 or 6 if we squeeze it. We'll see. Here we go. Thanks for being here. This is the Wise Money Show with Korhorn Financial Group. My name is Mike Bernard. With me in the KFG studios, Kevin Korhorn and Josh Gregory. Every episode of the Wise Money Show is on the Wise Money YouTube channel. Go to YouTube, search the Wise Money Show, subscribe to it there, follow us there, rate the program and as well, and you can share videos and leave questions and comments right there as well. We've got well over 1,500 videos on the Wise Money YouTube channel, so go to YouTube and check it out. All right, we are we're going through your tax planning checklist for fall of 2025. This incorporates not only individual strategies, but also if you own a business, but also the plethora of new tax law changes that we're all still digesting here that happened over the summer. One of the biggest changes in the new tax law changes had to do with the state and local tax cap, known as the SALT deduction. This needs to be incorporated in your planning this year. Josh, how so?
Well, yeah, I mean, we referenced this earlier in the show, but for a number of years here, we have been limited to only write off $10,000 of your state and local taxes if you're even itemizing, right? And a lot of people, the vast majority of Americans, have not been itemizing, partially because of that limitation. You know, you maybe spent a lot of money on your state and local taxes, your real estate taxes on your house, that sort of thing. When you combine that with things like your mortgage interest and any charitable contributions that you've done, maybe in the past you've been able to come up with a bigger tax deduction than what the government is offering in a standard deduction. But as soon as you start limiting some of those numbers, it just gets harder and harder. Mm-hmm. Well, one of the limits has been expanded again, not to an unlimited amount like it used to be, but now it's $40,000 that you can count in state and local income taxes, real estate taxes, that sort of thing. These local governments that are taxing you, total it all up, and it now can help you to get to an itemized deduction that saves you some money.
And therefore, if it looks like you're going to itemize, then that just opens up the floodgates of, well, then what else should we do? How can we optimize this? Should we pay a state estimate before the end of the year so that it counts towards that SALT limit, as opposed to when it's due, like you already said, Josh, January 15? Should we multiply or stack our charitable contributions, charitable giving, using a donor advised fund, something like that? A lot of opportunities you need to consider. But the point that we're making is don't put it on autopilot. If you've put it on autopilot, I'm not going to itemize. I'm not even close. Because of these rules, I'm not going to itemize. So I'm not going to go through the motions and at least do the math to see. No, it's time to shift that habit and confirm, are you going to itemize or not? I think a lot of people could itemize this year because of these changes and will miss out because they just have tuned out and just assuming, I'm not going to itemize.
That's right. You know, for how many years in a row have you just been unable to get up to that threshold? Eventually you kind of give up on it and you stop pulling together the right details for your CPA to put together on the tax return.
Yeah, if you have not been paying attention to this for a little while, it is time. And I would encourage you have some time before the end of the year. If you're not fully organized, start organizing your financial life and getting ready for tax time. Yeah. When I think about the time and energy and effort and the cost to GDP spent on compliance with the tax code, it almost makes me pass out.
I just did a video on the Wise Money YouTube channel where I just went on a rant about it's pretty ridiculous when you think about it, why we even need to complete a tax return.
Mm-hmm. Right.
Why is that needed? Most, if not all, of what will be reported on your tax return comes on official tax documents with your name and Social Security on it that are not only sent to you, they're sent to the IRS as well, and they're going to create a draft tax return for you. Why do you need to come? Why? Why do we have to do this?
You guys outrageous. Don't sound like business owners that help people prepare taxes, though.
I know right it's now. Just exasperating that the need is so significant, is so great.
Messing.
So, but it is.
But honestly, harder. Not to turn this into an infomercial. Here's the reality: there are less and less tax preparers available. So many people are getting out of that business, and if you find yourself scrambling to, locate someone who can help you with proactive tax planning, it's not too late in the year to begin a relationship like that. And reach out to us. We would be happy to either point you in the right direction or get you started on your own planning.
Yeah, and I mean, that rant was in a video about how it's more complicated and more dangerous to prepare your own taxes now. It is.
Sure.
Like, in pursuit of, hey, we shouldn't need to file returns, it's gotten way more complicated. You need someone, and like Josh said, there's fewer people doing it. All right, all of that discussion is leading us to right now, which is your 2025 fall tax planning checklist. Now, each of these steps, we'd encourage you got to be doing it with your certified financial planner. They're going to help you with each of these along the way. But first step is estimate your 2025 tax liability. That's not run the numbers to see, well, what do I think I'm going to owe? It's actually to build out a mock tax return. We call that a tax projection. That Josh said earlier in the show, that's the foundation. Everything else, you're just guessing and potentially even just using your emotions to see or having your emotions sway, well, what should I do? What makes the most sense? No, it starts. Step one, the first item on your checklist is to build out that tax projection, analyzing, here's what I think my tax year is going to look like in 2025. After that, tune into your withholdings and how much you're making in quarterly estimates. You'll be able to see, well, am I on track to break even? Are my withholdings right? So often, if you switch jobs or maybe you've got other income from dividends, capital gains, that sort of thing, these withholdings or what you're paying in for taxes drifts and gets off course, and you don't realize it until it's too late. Now in the fall, you can do that tax projection, check your withholdings, and make sure everything's the way it should be.
And that's scary if you realize that you drifted in the wrong direction and now you are under withholding and you're going to owe some money. The opposite can happen too. You realize that, oh man, I'm way over withholding and I'm going to have a big refund in the spring. Maybe you need to be reducing your tax withholdings if you believe that that's going to be true again next year. Because what if throughout this year you've been struggling to get the right amount saved for your most important goals, not realizing that some of the available cash that could be helping you achieve your goals is just piling up in Uncle Sam's pocket.
Right.
You're going to get it back eventually, but when you get it back in a lump sum, you may or may not be quite as disciplined at that moment to do the goal setting and the goal achievement that you normally would have.
Step number 3 here is not yet being opportunistic, but it is just reviewing, well, based on this mock tax return, this tax projection, what are my deductions and credits? What am I currently getting? Does everything look right? Did I have a child turn 17 this year? Did I have a child enter college? Like, what are the deductions and credits that I'm getting? And it's after that point, that's when the creativity starts. Step number 4, evaluate whether I should be doing pre-tax or Roth with my retirement contributions. That's a decision you need to make every single year, ideally at the beginning of the year. But if you're going to fund an IRA, you're going to look and, well, what tax bracket am I in? Should I do pre-tax or Roth? Step 5, evaluate different strategies, either from the new tax laws or other creative strategies to add more deductions, more credits to your financial situation to improve your tax picture. Consider giving strategies, estate planning strategies. That's number 6. And then number 7, if you haven't done that yet with your certified financial planner, review all of this with your CFP. Likely they're the ones creating the tax projection, reviewing your deductions and credits, reviewing your withholdings, coming up with the creative ideas. But step number 7 is review all of that with your CFP who's integrated with your CPA, and apply the right ideas, the ones that make sense. There's going to be a bunch of great ideas that, I wish I could do this. It just doesn't make sense for me this year. Apply the ones that do make sense for you this year.
You know, most Americans, they want to think about their tax picture one time a year. Just get that thing filed, tell me what my refund is, and then I don't want to give this any more thought. And we're telling you to do the opposite. Get dialed into this here in the fall, and then let that momentum carry you into the new year, because there's some early in the year tax planning opportunities that you want to be taking advantage of as well, and making sure that you don't let too many months go by without taking advantage of some of the tax strategies that exist out there. So let this be something that flavors all of your planning. Make sure it's part of the conversation you have with your certified financial planner throughout the year.
I think you're off by one. You said most folks only want to think about their situation
point.
once.
You got me.
I think
That's
you've
right.
overestimated.
That's
But
right.
you're a certified financial planner that's doing comprehensive financial planning. We started talking about that the tax planning is one of the 6 areas of your financial life. They love creatively helping you with that, and our team does as well. All right, that's all the time we have for today. On behalf of Josh Gregory, Kevin Corhorn, all of us at Corhorn Financial Group, have a great weekend. We'll see you next Saturday for the Wise Money Show with Corhorn Financial Group.
Securities offered through Silver Oak Securities, member FINRA/SIPC. Advisory services offered through KFG Wealth Management, LLC. Doing business as Corhorn Financial Group. KFG Wealth Management, LLC and Silver Oak Securities Incorporated companies are unaffiliated.